the consensus view that I distilled from the conversation was that investing in OpenAI at that time frame, because I talked a little bit about the CoreWeave deal and the timing and semiconductors and the infrastructure play. But at the time, the OpenAI deal was attractive for some investors, primarily because they got to go to their golf course or their country club or their flying club or their racing club and say, dude, I'm invested in OpenAI. And it wasn't about the economic return as much as it was the social credit. And I think when we were looking at these opportunities, we were saying like, look, this isn't a social club. This is about prudently investing dollars of clients in the most attractive opportunities from a risk-adjusted basis.
Risk-adjusted is exactly the right word. I'm not saying OpenAI will not do a 2x or 3x. It could. I wouldn't bet against Sam Altman. He's an incredible operator, entrepreneur, and Microsoft is behind them. It's powerful. Now they have issues though. We can get into issues some other time. The least of which is they're competing with their parent company for enterprise business, and they don't have focus on a customer segment. They're trying to straddle consumer and enterprise. How does that work? But the point is like risk-adjusted return. What's the return you're going to generate per unit of risk while being mindful of potential downside? It's hard to screw up CoreWeave when public comps like Prologis and EQIX trade at a higher multiple. And there's a path of liquidity that's coming in 2 years. So we can recycle capital into the next best opportunity versus waiting for 6 years. And you got an opportunity cost of capital around that time. Who knows what the world's going to look like after we go through the singularity, Stargate, wormhole. It's a human behavior. It's like this idea to be in the club. It's a bad behavior. It's a bad instinct to have. The bandwagon phenomena, which is another behavioral bias.